Okay, so I would like to introduce you Holger Danhoff. He's from Refinitiv. They are a global provider of financial market data and infrastructure, and in my opinion, the best tool to work with, even better than Bloomberg, because they have a very competitive pricing and around or even better data or more data. So if you're interested in the use of Refinitiv, which is pretty good in my opinion, I guess feel free to contact him on this mail address. Or do you want to add something, Danhoff, Mr. Danhoff?
First of all, can you guys hear me? Does it work? Hello? Okay, probably not.
I can hear you pretty well.
You can hear me? Okay, because I'm with my phone and with the laptop online. So if you can hear me, great. Thank you for that introduction, Richie. Well, basically, you mentioned everything important. I think the key argument is that you have to rely on the data given to make the right investment decision. But this is not my show, okay? So let's keep it short and crisp. If you're interested in learning more about our digital investment solutions, feel free to contact me via LinkedIn or email. And I think we should go back to you, Richie.
Okay, thank you very much. So we'll jump into the content. So first, I'm going to tell you a bit about myself, so you know who you are dealing with, and right afterwards, we're going to jump into the actual content. So we'll start with a short view on how the economic cycle works. Next, I'm going to tell you about trading strategies as well as investment strategies, where I will do some live tests. On one hand, with derivative trading, more to come on it, and as well, I will work with the Refinitiv workspace. In the end, I will reveal my current portfolio and then explain, based on the information I gave you, why I bought specific shares. And you will also have time to ask questions, express your opinion in the end, and take notes if you want. So have fun. So about me. So my name is Richard Schäli. I'm 13 years old and started trading with 7. I had a track record of several 100% in a trading competition and won. And I operated quite successfully in the past years. Not this year, but we'll see. And I'm managing 2 listed funds in Stuttgart and in Bern. You can invest in them, and founded the Richie Financial Trading Group more than a year ago. We are asset managers. So, the economic machine and its never-ending cycle. We're having some complications once again. So, sorry for that. Okay, so basically, as you can see on the slide, there are 3 lines: a constantly growing line and 2 fluctuating lines. This slide is very important to understand for you to know how the stock market is working. First, we have the productivity line. As you can see, it's not fluctuating a lot at all. Things are continuously going up. Next, we have the short-term debt cycle. He's fluctuating a lot. And in the eyes of investor traders, it's the player you are confronted the most. And finally, the long-term debt cycle. It's not moving a lot, but when it does, every 75 to 100 years, it's difficult on Wall Street. So now, what does all these cycles mean and lines? It's especially important to know what that, because the economy is meant to be a driver of the stock market, as it defines spending of consumers. Actually, it's much more complicated to explain what that all mean, respectively what they are responsible for or show, than a lot of people think. Usually one thinks that the only driver of the economy is productivity, because more productivity means more earning, and more earnings means more spending. That's not 100% true at all. So although productivity is responsible for growth in the long run, as you can see on the chart, one should not ignore the debt cycles, because debt allows us to consume more when we acquire it, and it forces us to spend less when we pay it back. So when debts are sky high and central banks have already choose the economy as much as they can, and in this instance, the central banks get interest rates down to 0 or less, allowing them to refinance its massive debts or at a lower cost. These and many other measures, such as deleveraging, stimulus packages, etc., are taken. So actually, what we are now living through could be a short-term debt cycle or a long-term debt cycle. In my opinion, a long-term debt cycle, but that's really open. So nearly the same happens in a short-term debt cycle, but it's just not hitting the stock market and the economy as much as the long-term debt cycle. And it does, and of course, the measures are not that significant. So we see the effect of these cycles in the stock market if, for example, a crash happens. And of course, usually stock market crashes are triggered by an event, but basically this event is a product of too much debt. So there are exceptions, like the current coronavirus crisis, but in general, it's about debt, because spending is reduced heavily. So, and we are seeing, but there's a second player, so nearly as important as that. So we are seeing him coming into play, especially in these times. It's inflation. Inflation is used to make currencies worth less, which has a lot of impact in stock. So here you can see the debt of the US government. So the federal debt, not the government. So, and here you can see it's growing exponentially, and to pay back debt, they have to make inflation to reduce the buying power of a dollar, and then reduce to pay back their debts for a much lower price. So that's the concept. So, all right, and the buying power of the dollar nearly is now like 10 times lower than it was 100 years ago, or even more. So that's actually because always if there's a debt crisis, you have to make inflation. So that's how it's been created. So it's a slow killer. You cannot buy the same with the same amount of dollars. You cannot buy a bread in 100 years. So now I would like to do a live example on day trading. And so therefore, we're going to trading desk. So, and so I hope you see the trading desk. And so actually, markets in the US are now already open, which means a lot of movements are now coming in. And what we now do is a live test. So there's something called derivative trading, as I mentioned before. Therefore, we borrow money from a bank or another organization to leverage our position. So today we're going to make a leverage trade on the DAX, the German index. Just for you to know, it's just paper trading. So I'm doing right now to only show you. So, okay, so the more important things is to use technical indicators if we trade without news, for example. So therefore, we're going to use some indicators here. Most important is the simple moving average, and the period should be around 50 on a day chart. And this is the white line around here. So the white line is the simple moving average. It shows us in which direction the stock market is going. So now the next thing we're going to add is the relative strength index. It shows us whether markets are overvalued, undervalued, level below 30 here is undervalued, the level above 70 is overvalued. Oh. Okay, so now what we're going to do is
die Antipo für Tegagefähig von Ding von Wasserstoff. Ah, das ist ja gut. Merci, danke.
hello. All right. So I have a short here and a long position here, and oh, sorry, this is a short position here and a long here, and now we're seeing that the simple moving average is acting as a resistance because we cannot pass this level. So what we're now going to do is placing a short. We can now, let's say, do all in so we can get things better. And as you now can see, we are now short on the DAX. And if we see any confirmation to sell, so we're not going to add a Fibonacci retracement. That's a possibility a lot of hedge funds are using. That's why it's probably working. So it shows you eventual support and resistances. This would be definitely a stop loss sign here, and here a take profit. So yeah, I think we'll keep that going, and we'll have a look afterwards again. So I guess the main takeaways here in day trading is that you always have to set take profits and stop losses, and don't have to get, greedy. Getting quick, get out quicker is important as well, and to be strict with the indicators so you are using to reduce losses. For example, here I can see now we're going above the simple moving average line, so we're getting ready to sell, and once a new candle opens and closes above the simple moving average line, we're selling, even though the stop loss is much higher, and we will go long again. That's basically the system. So okay, so I would say let's go to investing with Refinitiv. Okay, I hope you all see the Refinitiv workspace, and I would say let's start. Okay, so actually there are two ways to contemplate an investment. One is to take advantage of a certain situation. Example, coronavirus, we need vaccines, we need a face mask, and we need tests, etc. And as you can see on the presentation, on the image, this is my COVID bet. So this is our COVID stocks, and I just picked 13 of these to have a fairly large diversification. And now what I basically did was just looking for stocks developing vaccines or selling face masks, and that's the thing. So back then in mid-March, when COVID stocks were already really hyped, I decided to bet on COVID stocks. As you see, this bet turned out to work pretty well. So something for you to note is that it's nearly never too late to jump on a trend, except that you are aware that you have to exit quick in case the trend is broken. So, yeah. So let's go to Refinitiv again. We are going to have a look at a Chinese electronics company who makes and invests in smartphones, mobile apps, laptops, bags, earphones, shoes, fitness bands, many other products, even bicycle helmets. And I would say have a look at them. They are called Xiaomi Corporation. You may have heard of them. Let's see. So first of all, I have a look at the market capitalization. So I know with what kind of company I'm dealing with. In this case, we're having a market capitalization of 50 billion US dollar, as you can see. Okay, so after that, I'm now having a look at the revenues to get a sense of how fast they are growing. Okay, so let's go to the income statement here. And this is the revenue over time. And in this case, they're growing very fast, as we can see. They more than tripled their revenues, which makes them very attractive, which makes them a very attractive growth stock. But as important as growth, I think we should not ignore profitability. And let's see what their net income is. So, okay, so, and as we see, they are profitable. So they struggled heavily in 2017, but I see solid years coming in case if they are already profitable. So,
Richie, can you hear me?
Yes.
Hello?
Yes.
Okay. Sorry that I will tell you that late. You're not sharing the right screen, I guess. So what I can still see is your trading desk.
Oh.
Yes.
Well, thank you.
No problem.
Oh, yeah. I see. Now, do you guys see this?
Now it works. Yes. There we go. Okay.
So I'll probably repeat it shortly. So as we see, they have some solid revenues, high growth stocks. They more than tripled their revenue since 2015, and which is very important for me to figure out which stock I'm dealing with. They have a $50 billion market cap, and so let's move on to the net income to see how profitable they are. And as mentioned, they struggled heavily in 2017. For me to do would be due diligence afterwards to see why they struggled that heavily. And then afterwards, we see they have operated successfully, profitable for the 2 years afterwards. So it's probably going to be solid for the company. Well, so now so I want to see a significant sign that they are on their way to profitability. So they are all already profitable, and in case they wouldn't be profitable, I always want to see a significant sign that they will turn to profitability. I'm going to show you another example afterwards. So now I want to see whether the current price of the company, so the current share price, is around at the value of the company. Therefore, we're going to have a look at the P ratio. All right, so going to the P ratio, it's the price to earnings ratio, and it gives us a sense of how the price is in comparison to their earnings. So in this case, we have 27.35 times the earnings. That's the price. So I would say that's a good price to earnings ratio in case of a growth stock. We have much worse things such as Amazon. They have a PE of 138, but still they are a solid business, great business model. So You don't always have to worry in case the P is too high. Still, it's an indicator where a company is around. So if a P would be negative, it would also mean the net incomes would be negative. So just for you to know, and I guess that's okay as well. Now, before I mentioned a stock which is not profitable yet, but is on their way to profitability. Do you see my screen? I guess. No. Yeah. Okay, so it's a company called MTBC. They are an electronic healthcare IT company. And so what do they do? So they provide electronic health records, telehealth software, and technology-based medical billing. And this industry is currently booming. That's why I looked for a player and I found them. And their market cap is at $100 million, which makes them a small company in a multi-billion-dollar industry. Let's have a look at their revenues. Okay, so their revenues are strong as well. As we see, their revenue nearly tripled, which is still considered as a growth stock. So their revenue nearly tripled in the last 4 years. Apple's revenue, for example, only increased by 40% in the last 4 years. So just to give you an example, that it's seldom to grow as fast. Now, the even more important thing I wanted to show you with this example is the way to profitability. We'll have a look at here. So, as you see, usually a company, if it's creating larger revenues, they create larger losses. And so that's a challenge for a lot of companies. But now, in this case, we see that they have struggled in 2014, 2015, and 2016, but they are on their way to profitability since almost 4 years. So that's definitely a good sign. As we can see on a quarterly basis, they've already sometimes reached profitability, but we'll see. Okay. So now, next thing I'm going to show you is again my portfolio. So this is my current portfolio, and I'm now going to explain you why I have bought certain position. Okay, so probably first thing you hear if someone gives you an advice on investing, it's always diversify. But is it really that important? Actually, yes, it is, because sometimes unexpected things happen, such as frauds. Some very actual examples are Wirecard and Luckin Coffee. So if you would have done all in on one of these stocks, you're probably would have been vanished. So your portfolio would have vanished 95% of the value in a matter of a week, which would be very problematic, I guess. So, but on the other hand, I like to have some fluctuation and high return made with high risk trades. So, as you can see in my portfolio, nearly half of it is an Applied DNA, a $35 million market cap company developing and selling test-assay kits for COVID. A risky bet, but I'm quite confident because I talked to experts and the management before. And in the end, I became a major shareholder there because, the main reason I bought them is because if they successfully sell their tests, it can be transforming for a company in this director. So they sell test kits for a very competitive price and with only 1% error rate compared to competitors with sometimes 6%. And you can say it's my hedge against COVID. So I'm very confident there. Next is Xiaomi, weighted at around 20%. As explained, I see a bright future for Xiaomi as an Amazon-like company nearly, or Apple would be a better comparison maybe, but the probability that they will be in the Alibaba or JD.com league in the next few years is, in my opinion, quite big due to enormous growth. So I just hope they are not another fraud as we saw it before. That's risky currently in the Chinese environment. So next is MTBC, as already mentioned, a healthcare IT company which is growing pretty fast as well. And New Age Beverages is growing even faster. One of the fastest growing stocks worldwide. I guess one of the top 3 fastest growing companies. Their revenues have grown 10,770% in the past 4 years, making it one of the most attractive stocks I currently know. So there's actually no path to profitability, but a huge factor why I bought New Age Beverages is because it's very, very, very high. There's very, very high probability that they are going to be take over in the coming months, for example, by Coca-Cola. So, because I mean, they are really successful in the healthy beverage industry, and I guess for Coca-Cola as a not really healthy beverage company, it would be a great addition to their portfolio. So as you see, I really like growth stocks, and now a totally other stock called Impala Platinum. This is a very good example of bets. So I like doing bets. So what does that really mean? So I actually place bets, for example, COVID bet, the COVID bet. So I buy successful stocks which are in the industry or at least who are developing vaccines or were selling masks, and so that's the COVID bet. So in this case, I'm betting for inflation. So I guess that you all heard of the measures taken by the Fed, and as explained before, inflation is a big deal. And if the reason why inflation is such a big deal is because once the dollar worths less and the company still makes the same revenues and incomes, the company's shares rise automatically, because it's the same thing with platinum as well. So or with gold and other commodities. So they still worth the same. They still people still like them, so they are considered as a safe harbor investment due to no real fluctuation. So they are mainly driven by inflation, and I guess gold could easily double in the next few months if the Fed is going to continue like this, respectively all the central banks. Yeah. So now, do you have any questions? I can also, if you want, you can also have a look at a few stocks. Just give me some tickers and we'll discuss the basics of these stocks. No questions here? Or okay, so if there are really no questions, I guess I hoped I could have been helping you. We had some complications with the audio. But now,
Richie?
yes.
So actually there are questions, or there is a question. If you
Yeah.
look into the chat, it's
Oh.
the question was, what do you think of ASML?
ASML. Okay, so here's the chat. All right. Oh, here's a lot of. Sorry. So, ASML. Okay. So let's have a look again. So ASML. Okay, so first we're going to read some basics of the company. So the company is a manufacturer of chip making equipment. The company is engaged in developing. Okay, so now we'll get. Okay, their market cap is at $140 billion. Let's have a look at the income statement. Okay, consistently growing. Okay. So they nearly doubled their revenues in the past 4 years. That's definitely a good stock for that's definitely a good results for such a large stock, I guess. And I mean, they're okay. Let's just have a look at the PE ratio. 54.53. That's quite a lot. Much more for such a big company, but and even more, they are not too growth stock. But we'll have a look at the chart to see some history. Actually, guess if revenues are growing, they are growing okay, so it's definitely not in a decreasing phase. So I guess it's not the worst stock to invest in, but okay, so for some reason it doesn't work. You have some bad internet connection. Okay, so I would say in the end for ASML, whatever the chart now looks like, I guess semiconductor equipment is an industry which is stable, which is which is growing, and it doesn't look like, for example, the oil industry, who's decreasing in value, and revenues are also decreasing. So I guess it's a good pick for the long term, in case they are valued at 140 billion euros. So that's a lot. So I would say that's a good long-term investment. But I would have been digging deeper into it. Maybe a thing to look at would be the sales. That's also very important to. So as you see, sales. System. So as we see, they have also doubled. So it's okay. Yeah. So I would say it's a long-term pick, and it's definitely not bad stock. So yeah. Okay. Halliburton. Okay. So let's see. Okay, so the revenues of Hydrogen have decreased since 2014, which is definitely not a good sign. So now let's see how they managed to. Oh, okay. So, well, they have some complications. Market cap of $11 billion, PE ratio. Okay. I guess I'll have a look at the chart. Now having some. Sorry, I will. Okay, so oh. Okay, so I will now give. So let's have a look at the chart. I guess a company with decreasing revenue is never really a good pick, whether it's in the short term or the long term, because you're always underlying this risk of. I guess we're having some complications with the chart. That's why we're now going to have a look at the chart on Google. Okay. So in this case, it doesn't look good at all, actually. I guess.
Richie, can you share your screen again?
Oh, yes.
You're looking at Google right now, right?
Yeah.
Okay, there we go.
Right. So in this case, it doesn't look good at all. So the decreasing revenues and the bad net incomes are influencing the company negatively. I totally can understand that, because they are long operating and now back where they were in 1980, and I guess that's just not a setup I like. So it's going the stock price is probably going to be lower in the next, let's say 6 months. Yeah. So let's just have a look on where they are operating in. I'm going to share my screen again. Okay, so they're operating upstream oil and natural gas. Of course not. Of course not. Just ignore the gas and oil sector. So that's definitely not a place to go at all. It was funny to, invest at the bottom when the oil sector was totally oversold, oil minus 20% each day, and I made some money there, but right now it's not a hot thing anymore. So yeah. There's also another stock to IAC Interactive. All right, so as we can see, so you cannot see. Wait. All right. So IAC Interactive stock has been beaten down. That's not. Oh no. Okay, wait. Okay, so it's not a thing to go. I'm so sorry. I have to look at the income statements again. Okay, so revenues let's have a look at them. They are stable, not really, they are growing stable, so I like it. So those are the total revenues. Oh, sorry. So from 3 billion to 4.75 billion, that's a stable growth, I guess. So there's no problem. Net income, it's very it's fluctuating a lot. We'll have a look at the quarterly basis. Okay, so I guess they are in the online dating branch in the industry. So it's a growing industry, and I guess they are. I just guess they are a market leader, and they also they have just announced a business separation with Match Group, and as we can see, they are also operating in other segments. What's really good because they have a diversification in their portfolio. So I think they are not the worst stock at all. Yeah, definitely. And their PE is maybe a bit high. So that would be the only reason I would consider. Yeah. Actually, it's very difficult for me to answer the question if I will buy now, because in the current environment, I am very I really I am really careful with buying stocks which are very influenced by consumer spending, because I really fear a debt bubble. So we're talking about a long-term debt cycle bubble. So this would be around a decrease, a loss of 90% in the stock market. And, so I actually don't buy stocks anymore, which are influenced by consumer spending. I'm just buying stocks such as Impala, Platinum, which are for inflation, Applied, which are for COVID. Xiaomi, that's maybe an exception. They are so much growing, so I actually think if this is maybe my only bet to participate at a run-up of inflation. So once inflation is being created, this stock is probably also going to run up, because it still creates the same revenues and still creates the same net incomes, and so that's the way I participate at run up. MTBC and UH averages could be taken over anytime, so that's why I still hold them. And MTBC, they are in the telehealth sector, which is very, very relevant in the current situation. Yeah. For ISIC, actually, yes, as I said, I am very careful with buying stocks. So, no matter which stock. So, I cannot really give you buy a recommendation. It maybe will run up another 10%, but then once once revenues are getting hit by it, and you never know, but they're definitely much more attractive than any other stock, because they are operating in the internet space. So like online dating is getting relevant as well, I guess. So we're maybe seeing some growth in the next month. Okay, so I guess there are no other questions, or are there? Oh, okay. So thank you for joining. A lot of complications here, and I hope you liked it. And yeah, thank you. Bye.